Welcome to Trader UK, the money management channel. I'm Adam Hill, and today I'm going to show you how to trade options using Degiro. I'll explain the basics first of all, and then we'll walk through together on screen to see how the process works. The idea of today is that if you give up 10 minutes of your time to watch this video, then by the end you're going to understand exactly what an option is and how to make a simple purchase using the platform. If you haven't already, then make sure you subscribe to the channel for more finance related content. From stock trading to premium bonds, I'll cover it all. And if you enjoyed today's video, then please make sure you hit that like button. It's very, very important. A quick point to note, this is going to be a beginner level video, so if you already know your way around options, if you are already an expert, it's not going to be much use for you. However, if you're looking to learn, if you're looking to find your feet and you want to know a little bit more, then this is going to be suited for you. The thing to remember with options is that they don't have to be complicated. Of course, if you really want to know all the ins and outs, then yes, there can be a lot to learn. But when you're just getting started, it's important that you keep it simple, and that's exactly what we're going to do today. If anybody does want to know the ins and outs of options and how they work, head over to a channel called In the Money. The guy that runs that channel has put together a really good options tutorial. It's about an hour long, but it covers it very well. An option is a contract that gives its holder the option, but not the obligation, to purchase an underlying product at a set price on or before a future date. And as you can imagine, that is a really useful tool for anyone that's looking to buy a product that fluctuates, that moves up and down a lot in value. It also gives the holder a lot of flexibility, as they are never obliged to actually make that purchase. Now, there are different types of options contracts, and I don't want to get too confusing for today, but that's the basic definition. Of course, in this case, our underlying product will be shares in a company. Our options will entitle us or give us the right to buy shares in a company at a predetermined price on or before a predetermined date. Completely irrelevant of what the actual share price is doing. It's also important to remember that options contracts for securities come with a multiplier of 100, and that means that each contract will entitle you or give you the right to buy 100 shares in said company. Before we actually move on to the options trading, just remember that in order to trade options with Degiro, you're going to need an active or a trader account, and you're not actually offered either of these when you sign up. You're normally offered either a basic or a custody account. The only route that won't allow you to trade options is if you choose the custody account. It's never going to be enabled, so ensure that you sign up with a basic account first of all. Even then, you can see that trading in options is disabled. You'll take a quick appropriateness test and prove your product knowledge, and that upgrades you to either an active or a trader. It's a free upgrade, but it's just to prove that you know what you're talking about, you know what these products are. You sign the terms and conditions, and you accept the increased risk that possibly comes with some of these products. It's important to remember that with Degiro, you only have access to options contracts for some European companies. It's not going to be like Robinhood, where they can access options contracts for popular US companies like Tesla, Apple, these kind of things. We don't have that with Degiro. For the moment, it's only European companies. Hopefully Degiro will introduce more options in the future, or possibly Robinhood will launch their app in the UK, whichever might come first. But for the moment, this is what we have. Along the top edge, you'll see the filters, so you can filter your screen by market, by country, and then you'll generate a list of underlying products or companies. If you already know the company you're looking for, you have a quick search on the right-hand side, and then it will generate the latest product details below that. So Adecco Group, if you don't know, are a human resources company. They do temporary contracts, temporary staffing, that kind of thing. This is their latest share price, 45.19, down 1.71% for the day, volume of trading, etc. And then below it has generated a list of all the options contracts for the Adecco group. Each line is representing a different options contract. On the left-hand side, we have call options. On the right-hand side, we have put options. Call options are options to buy shares. If you want to have the right to buy shares in a company, use call options. And put options are the opposite. They will be the right to sell shares in a company. I always remember it that with call options, I can call on shares from the market, which is the same thing you would do if you were buying. And with put options, I can put shares back into the market. You can see the details summarized for each contract in the center. So these are Adecco options with a strike price of 32.50. The strike price is just the predetermined price that you'll be able to either buy or sell those shares at a future date. And that future date on this occasion is going to be the 17th of July. If you scroll down further, you'll then find August, September, October, and further into the future. The date will be called the expiration date. For the remainder of the video, I'm going to concentrate today on call options, the option to buy shares in a company. And you'll see with the data on the left-hand side, we have the same as when we're buying shares, a bid and an ask price. The bid, of course, is the maximum a buyer is willing to pay, and the ask is the minimum a seller is willing to sell for. And normally when you're buying a contract, you'll meet somewhere in the middle of that, as buyers and sellers have to give up a little bit of ground. You also have the volume of trades being made, and often you'll have a latest price. So remember, our current market price is 45.15. I'm going to scroll down to the 45 region. To make this a little bit easier, let's just pretend that the share price is exactly 45. Let's round it down. If we look at the options contracts that I've highlighted here, everything that I have highlighted has a strike price lower than the current market value. And that means when we're looking at call options on the left-hand side, all of these contracts highlighted are going to be considered in the money. And in the money simply means that you have the right to buy at a lower price than the current market value. So in theory, you could buy one of these contracts and sell it immediately or execute it immediately at a profit. And then anything below here that I've highlighted, this is going to be considered out the money. All of these contracts here, out of the money. You could buy and execute the contract immediately, entitling you to buy shares at 49, for example, but then you're only going to be able to sell them at 45, the market value. So they are out the money. And if you were looking the other way around at put options, it's going to be the exact opposite of what I've just said. There are many different uses for options contracts, but today we're going to be looking at it in its most simple form, which is using call options to profit from upward movements, or in other words, betting that the stock price is going to go up. So if Adecco is a company that I believe in, that I think is going to do well in the short to medium term, I can use these call options to bet on that. So we can use this option here as an example. Adecco strike price of 49, and it's going to expire on the 17th of July 20. Once I purchase this call option, the value of the contract is going to move up or down depending on a number of different influences. The most obvious influence is going to be the value of the underlying security, the value of that share. As the value of the shares move up or down, the value of the contract is also going to move up or down. If the price drops down to 30 per share, then my contract is going to devalue significantly, because the chances of it getting back up to where it needs to be, 49, before the 17th of July become very slim. They've diminished. And likewise, if the price jumps up tomorrow to 48.99, then the value of my contract is also going to jump up tomorrow, as the likelihood of it meeting that 49 is going to increase. And if that was the case, I might even choose to sell the contract tomorrow at a profit rather than waiting to see if it continues to rise, which means you don't necessarily need your strike price to be hit in order to make a profit. You just need the likelihood of it being hit to increase. The second influence that will affect the value of my contract will be time. As soon as you purchase this option, time will start ticking away, and that devalues every second that passes. The likelihood of it meeting the strike price decreases with time that passes. And then the final influence is going to be volatility. If you pick a stock that market value never changes, the company is never in the news, it's always plodding along nicely, then the likelihood of the share price jumping up is going to be very low. That lack of volatility is going to devalue your options contract. Whereas if you have a company whose share price is up and down all the time, you have someone like Elon Musk at the helm of the company keeping it in the news, then the stock price is very often up and down and volatile as well, and that increases the value of your options contract. Now let's say I buy this contract. We get to the 17th of July and the share price is still down at 45. In that case, the options contract will be considered out of the money and we do not need to do anything. We can just let the contract expire. Because remember, it's an option to buy and not an obligation. The only thing that we would lose in that case would be the price that we pay for the option. Whether the share price is down at 45 or 40 or 35, it doesn't matter. My losses are going to be capped at the price of the option. That's the great thing about options. Your downside risk is limited and you know exactly what it is when you enter the contract. Now let's say it goes the other way. We get to the 17th of July and the share price is at 50 euros per share. This contract will then be considered in the money. We can buy at 49 and then we can sell straight away at 50. But the truth is you'll never actually need to do that. If your contract is in the money, you'll still never need to actually do anything to execute it, to buy and sell. You'll simply just sell the contract on. The value of your contract will increase accordingly. If you could execute your contract and realize a profit of €1 per share, then the value of your contract will reflect that. If you could exercise your contract and realize a profit of €10 per share, then the value of your contract will reflect that. So all you need to do is sell your contract. And previously, when I said the downside is limited, well, the upside isn't. So if the share price shoots up, you're going to be able to realize all of that profit. And that's why options are so popular amongst traders. Limited downside risk, unlimited upside potential. In order to actually execute this contract, you can just click on the numbers on the left-hand side and it will generate the buying screen for you on the right. We can see the bid is 0.04 and the ask is 0.12. Check the details at the top. A deco contract, call option is what the C stands for. 49 is the strike price and it will expire on the 17th of July 20. You only have one order type in this case, which is the limit order. You can then set your price. If you desperately want the contract, then obviously you're better off going with the higher price, 0.12. That's a price that sellers are willing to accept. If you're not so sure you want a better deal, then you should be closer to the 0.04. Remember that each contract is for 100 shares. So even though the price I'm willing to pay is 0.04, you have to multiply that by 100, which will make 4. There's then an exchange rate variance. But each contract is always for 100 shares in the underlying company. Like when trading shares, you can also select a day order or good till cancelled. In this case, we'll go with a day order. Place order. The fee is 67 pence in this case. and confirm your order. That's it, guys. It will sit in my outstanding transactions now. If they find a seller for that contract at that price, I doubt they will because it's a low price, then it will move into my portfolio, and then the price will fluctuate up and down until the 17th of July. Once I own the contract, I can try to sell it at any point. I don't necessarily have to wait for that execution date. And remember, you never actually need to execute the contract. If it does expire out of the money, then I'll only lose the premium that I've paid for it. Whereas if the share price exceeds 49 and it moves in the money, then my upside is unlimited. That's it for today, guys. Hopefully you have a little bit of an understanding now of what an options contract is and how to trade them with Degiro. Let me know in the comments if you have any questions. And of course, I'll see you next time.